This is your Wall Street wake-up call. Global stocks plunging once again as the fallout from last week's Brexit vote continues. Let's get straight to London. That's where Michael Houston joins me. He's the chief market analyst with CMC Markets. So, Michael, stocks are down. The safe haven pylon continues. The pound is down another 2% against the dollar. What do you do in a market like this? Do you stay away from stocks?
I think you just got to wait for things to settle down. Certainly, I think in terms of European stocks, it's the banking sector that's once again really getting clobbered, not only here in the UK, but also across Europe. Deutsche Bank has hit another record low. Italian banks remain under pressure. And UK banks, Barclays and RBS, once again, their stock got suspended today as the share price once again came under pressure. Now, Mr. Osborne finally resurfaced earlier this morning, very measured in his tone, saying that the UK Treasury, the Bank of England, the government had a plan for dealing with all this volatility, and certainly Mr. Carney's tone on Friday appeared to suggest that the Bank of England certainly has got his fingers on the pulse, but the political instability here in the UK sort of rather gives the lie to what Mr. Osborne was saying earlier today. And I think at the moment, while this uncertainty remains with respect to the triggering of Article 50, the likelihood is the pound is likely to continue to remain under pressure, as are European and UK banks.
And do you think that this Brexit vote is a big worry for certain central banks as opposed to others, perhaps the BOE, the BOJ, and the ECB, and maybe not so much the Federal Reserve? Of course, we have BOE Governor Mark Carney canceling that panel on Wednesday that Janet Yellen was also supposed to attend. She is now canceled too.
Yes, I mean, I'm struggling to sort of look behind the reasons as to why they've decided to cancel their attendance on that European Central Bank panel. But what I would suggest is probably Mark Carney's got other things to worry about, given the decline in the pound. Once again, we're at a 31-year low. We're heading towards 130. The last time we were at 130, was in the mid 1980s. Mrs. Yellen probably doesn't want to field any questions about the timing of a US rate rise. I would suggest that's pretty much off the table for the rest of the year. And more importantly, I think it raises particularly important questions for the Bank of Japan, given the fact that the yen is once again coming under further upward pressure. I think if dollar yen breaks 100 and continues to move lower, then it's likely that we could well see further speculation about further monetary easing from the Bank of Japan and potentially intervention.
Yeah, well, dollar yen, we went to 99 on Friday. Pretty incredible. Do you think Brexit will be the biggest distraction to the markets for the rest of the year, sort of overshadowing the Fed, earnings, and oil?
No, I think there are much bigger problems to really be focusing on. I was looking at the bond market, and the bond market, the whole yield curve at the moment, out to 10 years for Germany, for Switzerland, for Japanese bonds, it's in negative territory. UK gilt yields have fallen below 1% for the first time ever. You're talking about $10 trillion worth of negative yielding bonds. Brexit is probably part of the problem, but there are a number of different factors that are likely to put further downward pressure on yields. Concerns about the Chinese economy, concerns about the Japanese economy, concerns about a slowdown in Europe. And I think that more than anything, Brexit is one part of that, but it's certainly not the whole story.
Yeah, that's a great point, because we saw those negative yields for weeks before that Brexit vote. All right, Michael Houston, the chief market analyst at CMC Markets in London. Michael, thank you.
Thank you. Thank you.
I'm Scott Gamm, and you're watching The Street.